Good morning, folks. This is Dan Bird on Sunday, the 18th of August. And I'm going to do a quick video today before the market opens tomorrow. I could not do it with Mr. Zuber this afternoon, so I'm doing a quick one on my own this morning. So I want to talk about a little bit about CPI that happened last week. Let me share my screen real quick. So here's my website if you're interested. The newsletter is right here in this box, free newsletter. You can sign up for a notification to be reminded that it's available by just going to the $0 one. It does not ask for a credit card, or any of the content that I show here today you can get for $99 a year or $15 a month, and you get a free trial, 7-day free trial. You try it out. By the way, this is the current status of let me make this a little bit bigger. Current status of the secular bull market that we are in. And you can see the indicators are up near the top, but it's still moving up. So it has really not rolled over yet. This is a monthly chart, so this takes a while. But we're right at the top of the channel up here. And I kind of figured we would come back a little bit, which we did last week, but then we bounced right back again. I'll show you that in a minute. So really didn't do much damage to the chart with the downtrend we've just had. And this is likely to last for another 4 or 5 years at least. But if you keep watching this every week, it's right on the front page. Whenever one of these turns red, then that means the secular bull is coming to an end, and we may be starting a secular bear market, which usually lasts about 12 years. So keep an eye on this. It's right on the front page, very easy to get to. Also on the top of the front page is the current status of the current secular bull, and that's what it looks like. So you can see the secular bear ended right here in 2013 officially. The bottom was in 2009, but we didn't know if that was the end of the bear until it breaks out of this previous high, which happened in 2013. So about 18 or 20 years, so roughly sometime around 2030, this should continue. And again, we're right at the top of the channel. You can see right over here. Actually, let me turn on my pointer. You can see right over here, this one is a weekly chart. So each of these bars represents a week. 2 red weeks, we went down. We started down about a month ago with a blue one. That's a neutral bar. Green ones are bullish. Red ones are bearish. And then last week, we had this really nice, beautiful green bar. So open way down here at the bottom and closed way up here at the top. So will that continue? That's the big question. But as far as the secular bull is concerned, we're still in really good shape. We're still quite a ways away even from the center line. That the center line is where we went during the 2022 cyclical bear market. We actually went out of the channel, so that was very overbought right there. And then it came back down to the center line. So if we have another one like that, which I don't think we'll have this year, but possibly next year, that could happen. We'll come back to the center line, which will probably be around the 2021 high, 4,800, somewhere around there. But we don't know if that's going to happen yet. That's far in the future. So let's take it one day at a time, see how it goes. All right, so let's take a look at CPI on the charts page. If we go down here and under the economic charts, the CPI headline is right here. And there's the big gap right there from a year ago. So this is called the 12-month base effect. This blue box right here represents 12 months. The base effect means that the way that headline CPI is figured is it's based on the rate of change from 12 months ago, which you can actually see down here. So this is the rate of change right here. 2.92 is the actual number. So they reported 2.9. Forecast was 2.9. Last month was 3. I thought it might come in a little bit better, but yeah, coming in, right at forecast. The market didn't love it, didn't hate it, didn't do much that day. The next big report was the unemployment claims, which came in better than expected, and retail sales came in better than expected. So that's why the market started to go up. But if we look at CPI again and look at the one that dropped off in this report, so you can see the previous two were fairly small ones right there. This was a relatively larger one, so that would help the CPI. But look what's coming up in September and October. Huge gaps in those two. So what that's going to do when CPI is reported, especially if inflation is under control and commodities continue to come down, which I expect that they will, then this is going to have a significant drop right here. So we could be in October, just before the election, coincidentally, we could be around 2.5%. Now, 2.5% represents not inflation. So keep this in mind whenever you hear of all the politicians talk about inflation is coming down and we're finally conquering inflation and we're bringing inflation down. It's lower than it was. Well, that's not exactly true. What they mean is the rate of change of inflation is coming down, and that's true. So what you can see down here with the 12-month, you can see the rate of change is coming down. So that means inflation is going up by 2.9% per year. Last month, it was going up by 3% per year. So yes, the rate of change went down. So it's not going up as fast as it used to, but that does not mean that inflation is coming down. So keep that in mind. We actually had 1 month of deflation back here. This is the 1 month rate of change. So this is going to be good news for the economy, for the market. I think the market will probably like this when we get these two CPI numbers. I expect to get a rate cut in September. And I think right now that rate cut is still going to be 25 basis points. It's going to be dependent on the unemployment rate. So, which is up here in my recession watch. And that's the first one I think that we're going to check the box. We've actually really checked the box already. So you can see right down here, the inflation rate is starting to head up significantly. And I actually think it's probably going to be stable in the September report, the one just before the Fed has a rate cut. So I think for that reason, if it goes up again, so it's at 4.3 right now, if it ticks up to 4.4 or anything above 4.3, then potentially the Fed will cut 50 basis points. But I don't think that's going to happen. I think it's going to come in at 4.3, maybe even a little lower, because I think based on the unemployment claims, I think that was a positive number. So I think it's going to pretty much stabilize. So the Fed then will say, everything is going great. We'll drop rates by 1/4 point in September. That's what I think is going to happen. Doesn't mean it will happen, but that's what I think will happen. But every time we have a rate cut, we get a recession about 4 to 6 months later. So just keep that in mind. Rate cut, recession, rate cut, recession, rate cut, recession. So September is shaping up right now to start ticking off all of these recession watch boxes. If we look at the yield curve, here's unemployment claims, just to look at that for a second. So here's the claims way down here. And you can see they're moving right along sideways in this box for quite a while. And there was nothing in the report this week that indicated that it's going to dramatically go outside that box. So I think it's going to stay in there. But the other one, inverted yield curve, it was rapidly going back to zero right there. You can see that I think this is a weekly report. Yeah, this is a weekly. So each one of these dots represents 1 week. So you can see these 2 weeks here, it was rapidly approaching zero. And in fact, if it kept going on that trajectory, I was expecting in 1 week or 2 at the most, we would be above zero. And that's the second recession watch indicator. Anytime the yield curve uninverts, then a recession comes 4 to 6 months later. However, look what happened. Last 2 weeks, yield curve started dropping again. So this might push it out a little bit further. I think it's actually going to start to come up much more rapidly once the Fed cuts for the first time. So again, in September, I think this or October sometime, I think this will start to tick higher. And the second one of our recession watch indicators will be checked off as well. And we'll continue to watch that. All these charts are out on the website. You can check them yourself and they update automatically. And then rate hikes, of course, is the other one. Whenever the Fed cuts, we get a recession. So that's what the economic indicators look like. Let's take a look at the bottom finder. So I created, actually, I mentioned this on the channel a couple of weeks ago, and folks said I should create a chart for it. So I did. I did one for the S&P and the NASDAQ. We'll look at the NASDAQ. So up here you can see the momentum indicators. They're starting to move higher now. So that's good. These have continued going lower. That means the market would continue to sell off. Anytime this black line for the MACD right here crosses 0, then that's confirming a downtrend or an uptrend. So if it crosses it to the downside, that's confirming a downtrend. It has not yet crossed back above 0 yet. You can see back here where it crossed above 0. Just follow that down to the NASDAQ 100 right there. And the market started to take off right from that point. Here's where it crossed below 0, and that's where the market started going down. Actually, it had started a little bit going down, but that confirmed it. Same thing right here, went below 0, confirmed it. It had already started down, but it confirmed the downtrend. We want to see that get back above that 0 line. But the important ones are down here. So this first one is the percentage of stocks that are above their 50-day moving average. And I put these vertical blue lines here where the last bottoms were. So this is the one in April, and this one back here was the one from 2023, where we had basically came down, went up, came down a little lower, went up and came down even lower. So these are lower highs and lower lows. And what you can see is this one, the percentage of stocks above their 50-day moving average got down to 15% right here. So this is the NASDAQ 100. That means out of 100 stocks, only 15 of them were above their 50-day moving average. And the 200-day moving average, which actually usually moves even slower, was actually down to 30% down here. Same thing in April, although it didn't come down quite as far, but right there it came down to 20. And the one for 200 didn't come down quite as much, but both of these came down quite a bit recently. And look at the NASDAQ, the VIX, sorry. The VIX right here spiked significantly. And that usually is what happens, but usually when we're forming bottoms like this, when the market continually sells off, we get a VIX above 20, that's the red line, and we can keep that reading for a while. This actually is a daily chart. So these are, for about a week or two, we had a VIX above 20. Over here, it was a week, it spiked significantly, but now it's all the way back down below 15 again. So the VIX is back down to an area where the market doesn't see much fear. Right here in April, the VIX spiked just about to 20. It did not go above it, but you can see it wasn't as severe as a downtrend. So these are the things that I watch. This is the bullish percent index. So it's the percentage of managers that are bullish. Right here, whenever it gets down below 30%, that's usually the time when the market starts to bottom. Happened both times here. And the one down below is the advanced decline lines. This is the number of advancers versus decliners. Got to a low right here. But back here in 2023, notice that we had a low for the advancers decliners as the market hit a low. We hit another low as the market hit a lower low, but it did so with fewer decliners. So in other words, more advancers than decliners, even as the market hit a lower low than the last time. And then it hit another lower low in October, but also on fewer decliners. So there were more advancers and fewer decliners, even as it was hitting a lower low each time. That's indicating that this downtrend is running out of steam and it's getting ready to turn around. So those are the things that I watch, and this updates automatically. Right now, we're right at the 50-day moving average, so that's going to be a significant support level, or resistance level, sorry. And the one thing that you might notice for those that can pick out patterns from technical analysis, I'll actually draw that in here, and this was in my newsletter this week. So what you'll notice over here is we have a left shoulder, we have a head, and we have what may end up being a right shoulder somewhere over here. Don't know where it might be, but somewhere in that neighborhood over here. And that could, the location could change, but somewhere roughly right about there. So what that means is we right now are sitting right on the trend line of the neckline, the inverted neckline, right about there. You can see we're right at it right now, right there. So the way to measure, and I want to make very clear, this is not a prediction. I am not predicting this is going to happen. I'm just pointing out a potential pattern to watch. And if it doesn't do this and it goes, busts through this resistance line, then this is negated and I'll delete all of these and it won't be a pattern anymore. But I think we may get rejected next week. We might have one or two more up days or sideways days, and then we may sell off. And September is the worst month of the year. I'll show you something on that in a second. But if this does come to pass and we get a right shoulder over here and that starts back up again, and then it breaks through the neckline, then the measured move from there is up above the previous high, somewhere up here. So that could happen by the end of the year. So just keep that in mind. By the way, you'll notice that on lots of other charts as well. If I go back to the website and look at the trend models, look at the Magnificent Seven, and one thing that you should notice, now these show you the short-term, medium-term, and long-term trends of all of these different symbols over here. Most of these are Magnificent Seven, and I added a couple of other ones in. But anything highlighted in yellow happened last week. So you can see all the ones that changed to short-term uptrends last week, and one of them had a medium-term uptrend. We had Tesla that gave a medium-term downtrend, and AMD gave a long-term downtrend. But the important ones that I look at are the short-term uptrends. So you can see right here, NVIDIA just gave a short-term uptrend. If we look at NVIDIA, you will actually see right here, so it's where the pink line, the 5 crosses the 21. There's the short-term uptrend signal right there. You can see, as I've been saying for a while, NVIDIA usually runs up into earnings. So expect about 2 to 3 weeks before earnings, and earnings is on August 28th, that is going to start its move higher. And it's been doing that. It hasn't really stopped. But what you'll also notice over here is a left shoulder and a head. And we're right at the resistance line, the neckline. If I draw that line in, one here, right about here, we hit that resistance almost to the tick on Friday. So NVIDIA may be getting ready to take a brief rest. It might come down here about to 115 if I draw another line in the bottom of this shoulder. Puts it right there, roughly right around 115, 116 area. So if NVIDIA pulls back down here next week sometime, then it may be setting up for an inverted head and shoulder as well. So where would that put it? Well, the head is down here at about 100. The neckline is here at about 125. So that's a 25-point move. So if it comes down and then starts back, this is a big if. I'm not predicting this. I'm just pointing out a potential pattern. If it comes down and then starts moving higher and then breaks out above 125, I guarantee you there's going to be lots of people with buy orders sitting right above that, and that's going to propel it higher. The measured move is that 25-point range between 100 and 125, which means the target is 150, somewhere up there. So again, not a prediction, but it's amazing how many charts look like this right now. Not just NVIDIA, but the overall market looks this way as well. So let's talk about Let's talk about seasonality for a second. One more thing on the trend models that I've just added is I put in the zoom in and zoom out areas. So we can zoom in and get a closer look of NVIDIA. And in this case, where the pink line crosses the blue, or the 5 crosses the 21, that's my short-term signal. And on the chart I just showed you, the pink arrow is right there. But whenever it crosses above, when it closes above the 21 day, which happens usually before that signal, then that's an early warning signal. So actually could have got in right there. So that's on the zoom in ones. And I actually did get into Tesla because Tesla did that right where that arrow is. I get into Tesla right there. So we're going to watch it and see what happens. Of course, I set my stops, and as it moves higher, I move my stop up. And my goal is to get my stop to break even. And hopefully, if you're paying attention, you're looking at charts and looking for patterns. There's a left shoulder, there's a head. So it could come up to the neckline, which is up here at about 235, get rejected, come back down to form a right shoulder over here around 215 and 220. And then if it starts back up again, then its measured move would be about 40 points above this. So about 270, 275, which is right where the high was. Again, not a prediction, doesn't mean it will do this. I'm just pointing out that there's a potential inverted head and shoulders on Tesla as well. So that's the way I use the zoom in. The zoom out basically is just a 2-year long-term chart. If you're a long-term investor, the most opportune time to get in is when it changes from red to green right there, and you would still be in it. You wouldn't have been out at all. All right, so let's take a look at seasonality, because that is something that is very interesting. I'm going to do this for SPX. And let's see. Stock Charts has changed their views a little bit. So I got to find where they rearrange things. Seasonality right here. So in Stock Charts, it gives you the ability to look at what a stock, this is not the stock I'm looking for, but let's change this to interesting. Let's change this to a different list. And there's SPX right there. All right, so this is a 5-year view. See 5 years right there. Look at September for the S&P. This is what all the indexes, pretty much what they all look like. The worst month of the year, down 5.7% over a 5-year period. If I take this back and look at this over 10 years, September is still the worst month, by far the worst month. And August is when it starts, and September is by far the worst month. It often goes into October, but usually the last week of October is when the rallies start to happen into the end of the year. So I just think this is interesting, looking at this from a seasonality perspective, and it can really help with managing risk. If you know this is a 1-year chart, doesn't tell you much, but here's 2 years, 3 years, 4, 5, there's 5 years. So going back 6 years, it starts to do a little better, but still worse than anything else. Well, we'll look at 10 years. And we can also look at it a different way, and that's by looking at all of the years side by side. So there's a 10-year chart. Let's look at it from 5 years just to make it less busy. There's 5 years. And what you will notice is we're way up here right now. But notice here's September. So the past 5 years, look what happened in September. So here's beginning of September, end of September. This is for last year. Here's the beginning, there's the end. That's for 22. 21, beginning, end. 2020, beginning and the end. So almost every single year looks like this. September is the worst month of the year. You can see last year, this was the bottom right here. So we went from basically the beginning of August. We had a lower low, a lower high, a lower low, a lower high, a lower low, and that was it, the end of October. These 2 years here started going up sometime in the middle of October. And this one here was right at the end of October as well. Now, this year, of course, we have the election happening right in November, so it may get delayed a little bit till the election. But this is typically what happens. This is what seasonality looks like. We can also look at these 5 years, all starting from zero on a 5-year period. And you can see, again, in September, all of them basically are going down in September. And that's where we are right now. So you can kind of track where we are versus what the seasonality typically looks like. So we might, still have a little bit of a run in August, but September, I would secure your stops, maybe even take profits or take partial profits, and then wait and see what happens. The Democratic convention is next week. No telling what will happen during that. So I expect it's going to be volatile between next week into the election. So that's where we are. On the homepage, by the way, under the S&P, I put in that inverted head and shoulders potential right here. It's in green. So you can watch that. Again, we came back right to this resistance line on the S&P, almost to the tick, almost exactly. In fact, I can see how close it was. So the high on this one was 55.6616. The high on this one was 55.54. 55.54 and 55.66. So what 12 points, within 12 points of each other for that resistance. So I would not be surprised at all to see the sell-off next week. And then we want to watch to see if it comes back down to this support level. This actually is a major support level. It's an open gap down here. So come back down to about 5,400. It's also the 38.2 Fibonacci level. So if it does and then starts back higher, then we have an inverted head and shoulders. And guess where the target for this is for the S&P? If this actually happens, and I'm not saying it will, I'm not predicting, I'm just pointing out a potential pattern. The target for this is 6,000. So if all of this comes to pass, and we'll continue to watch it and look at it again next week, but the target on this would be 6,000 way up here. So that's it for today. Hope everyone has a great week. By the way, I want to thank all of the subscribers that joined the Zoom call that I did yesterday. There was a really good turnout. Lots of great questions. I tried to answer as many as I could. Anybody that is interested in participating, it's an open dialogue. It's back and forth. In fact, anybody watching this, if you have any, and you did join the Zoom call, if you have any comments about what you thought about the content and also what you learned, please put them here in the comment section for this YouTube video. And the recording will be on the website as well. I'm going to probably put that out there today. So those that missed it, if you're a subscriber, then you can come out to the website, to the webinars and newsletters page. And I already have it set up right here. I haven't added the video yet, but I'm going to do that today. So that'll be right there. All right. Thanks, everyone. Have a great week, and we'll talk to you soon. Take care.